Plantation Division. Question A. Barrel plants. MFRS 116. The oil palm trees are classified as barrel plants because they produce fruit for over 20 cycles without being consumed themselves. Measurement carried at loss, accumulated depreciation, and impairment. Analogy accounted for exactly like factory machinery. Second, biological assets. MFRS 141. The fresh fruit bunches FFB growing on trees are biological assets until harvest due to continuous biological transformation. Measurement, fair value less cost to sell FVLS CTS. Reason reflects value of transformation and yield potential. Faithful representation in agribusiness. Asset functionality mature, trees act as biological machinery, infrastructure, not consumable, inventory, depreciating them over time matches usage cost with revenues, preventing volatile and unearned asset revaluations on long-term assets. Output volatility, the actual consumable inventory FFB changes state rapidly. Applying MFRS 141 to growing FFB captures the real-time value generated by natural biological growth rather than transaction mechanics. Integrity of the balance sheet, separating the factory from the which is tree from the pipeline inventory FFB, prevents arbitrary valuation swings in permanent farms infrastructure, maintaining balance and should reliability. Compromise qualitative characteristics. Faithful representation. The CFO's calculation ignore physical reality. An immature bunch has zero current market value because it cannot be processed for oil. Recording it at 6,500,000 creates a material misstatements. Faithful valuation looks like faithfully represent the valuation under MFRS.
As a junior accountant, the ethical risks here are significant. The CFO has instructed the team to use the full market price of 160 ringgit per ton for immature FFP without any risk adjustment. By complying, I am violating the fundamental principle of integrity as I will be knowingly participating in the preparation of misleading financial statements. Furthermore, the CFO is under pressure to impress a potential strategic investor with a higher asset base. Following this instruction would mean sacrificing my objectivity to help the company secure a better deal rather than reporting what is true and fact. Finally, I will be failing in my duty of professional competency by applying a valuation method that I know is flawed and ignores the reality of the crop's immature state. Before I raise any concern, I must be prepared. I need to gather the relevant technical standard that explain why the 650 ringgit price point is inappropriate for immature biological assets. My first step is to have a private and professional discussion with the CFO, presenting this fact as a concern about compliance and reporting quality. If the CFO insists on the original and float valuation of 6,500,000, I have an ethical obligation to escalate the issue. I will take this to the internal audit committee or the board of directors. Throughout the entire process, I will keep detailed private records of all conversation and instruction to ensure I am protected if the integrity of financial statements is questioned later. Finally, what do I owe the external users, especially the strategic investor? As an accountant, my duty to the public interest is higher than my duty to my employer. These financial statements will be used for strategic investment decisions. If I allow an inflated fair value gain of 6,500,000 to stand, I am directly participating in misleading the investors, which could lead to significant financial loss for them. My professional obligation is to ensure that the information provided is transparent and accurate, allowing the users to make decisions based on economic reality, not management bias. Upholding these standards is vital for maintaining the credibility of the entire financial reporting profession.
Talk about the question 2, which is about real estate property. Now, we will discuss how can we properly classify 3 properties under Malaysia financial standards and evaluate the CFO's proposal. Prime Development Bkark has 3 properties and the CFO want to classify all of them as investment property under MFRS 140 using the fair value model to increase reported profit. However, we must analyze whether this is appropriate. First, property 1 is a mixed-use building. The 7th floor should be classified as investment property under MFRS 140 because they generate rental income. However, the 3rd floor, used as headquarters, must be classified as property, plant, and equipment under MFRS 116. Since these can be separated, they must be accounted for separately. Second, property 2 is land with no clear plan. If the intention is to hold it for capital appreciation, it can be investment property. But if it will be developed for sale, it should be classified as inventory under MFRS 102. So classification depends on management intention. Third, property 3 is under construction to be sold. Therefore, it will be classified as inventory under MFRS 102. Investment property can use fair value. Property, plant, and equipment are known as PPE, use cost with depreciation, while inventory is measured at lower of cost and net desirable value. In conclusion, the CFO proposal is incorrect because it misclassifies asset and overstates profit. This violates faithful representation as financial statement must reflect the true economic substance.
Let's discuss with me the simple answer for question 3. So basically, question 3 asks us to recognize whether the product legal cause and lawsuit can be considered as provision or not. Before we deciding whether these cases can be considered as provision or not, first we need to look at the criteria of provision. There are 3 criteria of provision. The first one is present obligation. The second one is probable outflow of economic benefits and reliable estimate. So let's compare these criteria. So first, we look at the product legal cause. Present obligation. The contamination of fresh taste food manufacturing berhad is occur before financial statement end. Therefore, the company announced the recall and creates a present obligation. So we can see right there, the first criteria is fulfilled by the product legal cause. Second one is probable outflow of economic benefit. Management of the manufacturer estimates that approximately 17% of the affected products will be retained, making an outflow of resources highly probable. So the second one criteria also is fulfilled. And the last one is reliable estimate. The company estimated the cost to be RM1 million. So there are specific amount in there. So we can see that product legal cost is fulfilled with all these 3 criteria of provision. Therefore, the company should recognize product legal cost as provision for that year. Okay, the second one is lawsuit. Present obligation. A lawsuit has been issued. A possible obligation may exist. Okay, first criteria is fulfilled by the lawsuit case. Second one is the lawyer advises see that there is only 30% chance of losing the case. So an outflow is not probable. So the second criteria are not fulfilled by the lawsuit. The third one is reliable estimate. The amount just can be estimated up to RM2 million to 3 million. So there is no specific amount of that. Therefore, the company should recognize lawsuit as contingent liability for that year. Under MFRS 137, it says that an outflow of economic benefit is probable, a provision is recognized. Therefore, product legal cause is categorized as provision as the uncertainty exists regarding the exit cost. At the same time, the obligations and outflow are probable. That's why we recognize product legal cause as provision. Second one is MFRS 137 also that when outflow possible but not probable, the outflow will disclose as contingent liability. For instance, uncertainty of the lawsuit relates whether the company will lose its case. Since the chance of losing is 30%, therefore the outflow is not probable, and then it also reasons why we disclose it as contingent liability.